is Ali Safavi, CEO and co-founder of Kovu. We're here with you again for another episode of InsurTech Unscripted. Today, I have the honor to have a great chat with Alex Nihenke, partner at Scale Venture Partners. I had a chat with Alex not that long ago. And even though Scale is a generalist fund, the way that he was talking about InsurTech, I thought that's all he has been doing for the past 20 years. I realized it's just, he has a lot of interesting thoughts, a lot of interesting theses around InsurTech, the future of InsurTech. He's excited about the future of InsurTech, and I thought it's going to be a conversation and that a lot of you would also enjoy listening to. So that being said, maybe we'll kick it up with Alex. You could do a quick introduction of your background, how you got into InsurTech, and maybe some of the deals you've done in insurance.
Of course. Thank you so much for having me. This is super fun. And I think as you caught on, I love talking about insurance about as much as anything, which, if you'd asked me 15, 20 years ago, what was insurance, I would have said, it's something that I think I need for my car. And it's just been one of those real pleasures to dive into the industry and make it one of the core areas of my focus. So I work for a firm, Scale Venture Partners. We're investing out of a $900 million fund, and we look to invest in early stage companies that are moving from a CEO or founder-like go-to-market to a scalable, repeatable go-to-market with a strong emphasis on business software and services. Within that, obviously, insurance is an area that I cover. We generally write checks in the $5 to $25 million range. I have been an investor my whole career, so I started venture investing 15 plus years ago, joined Scale 10, 11 years ago, and plan to do this for the rest of my career. It's something that I deeply, deeply enjoy. Within insurance, I have been either a board member or investor in Root Insurance, which went public a couple of years ago, Archipelago Analytics, which is in large property, P&C insurance, a system of communication and collaboration for all the constituency in that. Out of New York, Spruce in the title insurance space, really trying to disrupt what is a bit of an oligopoly in a market that has, really attractive loss rates. And then I've also invested in a couple things that are in some ways tangential to the insurance industry. So in the kind of aerial imagery and reality capture market, a company called Drone Deploy, where we have a number of the leading carriers who buy our software in order to help their underwriting or their claims decisions, as well as in the payments and security space, a company out of Israel, Forder, that use machine learning to detect fraud in card-not-present transactions. But as is often the tension in security, does the software work, does it not work? We actually bundle an indemnification or insurance product for a customer. So we will actually take the risk of underwriting the transactions if the customer so choose in order to make that decision that much more compelling for them, and reflects the confidence in our product.
Very cool. I also see on your background, you have some InsurTech stuff on the whiteboard. So it sounds like you're pretty deep into the InsurTech world.
Yeah. No, we were doing a little brainstorming the other day about some new thought pieces we maybe wanted to write, and some just trying to get our bullishness about the ecosystem out there.
Makes sense. So let's kick it off very easy. What is the most controversial idea you have about the InsurTech space and maybe like the future of the insurance industry?
Yeah, I'm probably about as giddy and as excited about insurance as anybody is right now, and I think that that's a little surprising to some, and particularly from a venture landscape perspective, maybe even contrarian in the sense that you saw, almost with the rise of InsurTech Connect, the conference, the rise of insurance, which, for me, my work in insurance started years before going to some of the fintech conferences where the asset management nature of insurance made me curious about it, made me start focusing on that, and then did some real comprehensive work in 2015 as we started diving deeper in the sector. But I remember within fintech, I started that work in 2008, 2009, and there was this period in 2013, 2014 where a few companies had gone public. Those companies had underperformed. I'm thinking about some of the kind of small business and consumer lending companies. And there was a couple of years in there where people were like, well, maybe this fintech thing was a bit of a mistake. And then we had a resurgence. We got out of that trough of sorrow, and the next 5 to 7 years really created, tremendous exits, tremendous success for entrepreneurs. And I think in many ways, insurance is going through that same phase where we had a few companies that, went public, have probably underperformed expectations and have put a bit of a cloud over the ecosystem. And I think that the entrepreneurial activity that I'm seeing now is incredibly tangible and is going to set the way for a ton of really big breakout successes over the next decade.
Very interesting. And so basically what you're saying, if I were to paraphrase it, is that there were some things that happened that scared investors, and now you feel like there's a big opportunity in insurtech that a lot of people are missing out on or not paying attention to. So, what do you feel like people have got wrong over the past few years?
Yeah,
So, like I think Root is a good example of something
yeah.
that.
Well, I think the first thing that I always try to remember is if you decide to actually go down the carrier route or potentially the MGA route, it's a bit of an insane assumption. Like insurance is a business model, right? In every other business, you purchase a good and then you try to sell it for more. And within insurance, lending is like this too. You're like, no, 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 we're going to sell a product and we'll figure out how much it costs us later, right? Which is a bit of an insanity as a business model. And as part of that business model, there's some real misalignment with venture capital in the sense that venture capital is all about growth. And in a risk taking business, there is no constraint on growth. And so, board members like me can show up to a board meeting and be like, well, we should grow faster this quarter. And the cost of those decisions won't be paid until a few quarters, maybe a few years later. And so in the 2019, 20, 21 growth overall mindset, the first thing that happened was just an immense amount of capital pouring into the sector to encourage an immense amount of growth into companies that in some ways were not mature enough to handle that growth and therefore did decisions that in hindsight are probably going to limit their success or going to force them to go through an incredibly painful process. And so I think with some of the companies that I quite admire, I'm an investor in Root, Lemonade, Hippo, you can see them going through those growing pains in the public markets because they grew so fast. But as part of that, there was some decisions where they probably took on some business that they shouldn't, or they didn't refine parts of their business model that they should have. And now they get to do that under the public spotlight. And that's really tough. And I think to scrutinize the whole industry as challenged because of that to me is very, very narrow-minded, particularly since so much of the ecosystem doesn't even underwrite risk. They sell software tools that enable carriers to run their business better, or they enable brokers and agents to be more successful in their business. And so, I think it's short-sighted to take those those challenge stories and project that onto everything. And I also think all three companies that went public, that is, Lemonade, Root, and Hippo, they each had actually relatively distinct challenges that aren't perfectly correlated.
I also think it's a little bit crazy to me that we're talking about three companies that are MGAs or carriers, and we're calling that insurtech. That's a very specific model that is a very small part of what insurtech is supposed to be. And somehow investors are saying, and at the same time, the reason that the market got penalized was because investors were valuing it wrong. They were
Yes.
looking at insurance premium as SaaS revenue, which makes
Yes.
absolutely no sense.
Yeah.
And then they're pissed at the industry that insurtech doesn't have potential, which to me
Yeah.
is crazy.
Yeah. Yeah. Yeah.
And
I think we underestimated how difficult it is to build that type of business, and we misvalued that. And I think we were also dismissive of the incumbents and what advantages they have, right? Because they have basically unlimited capital to a varying degree, right? An insurance company just has tons of money, and they have tremendous historical loss data. And I think within that conversation, for example, Archipelago is led by Hamid Shah. He built RMS Analytics starting in the 90s, and in 2016, 2017, he sold the business earlier, but that business got sold for a few $1 billion to a private equity buyer, right? You look at Vertafore transacting for $4 billion. There are incredible businesses within the insurtech sector that are the enabling technologies. Or, I mean, Guidewire has been a great stock over the last decade. So
it's actually funny. Our next podcast is with Marcus, the founder CEO of Guidewire, who's at Battery now.
yes,
Yeah, I'm a very big fan. I was telling him, I think like you're the OG insurtech founder before insurtech was insurtech.
that's right.
And I have a tremendous kind of respect for what he's doing and what he's still trying to do with Guidewire. But yeah, I feel like another thing with MGAs that investors got wrong was two or three things, not just one. One was I think people thought distribution is all about online marketing, and then somehow a few years later they realized agents actually provide a lot of value in distribution, especially access to the right kind of distribution. I think people forgot how complex insurance is and how much people value advice and guidance and the relationships that are already built offline through these agencies. And I also think people didn't appreciate the fact that the OpEx of the insurance company is less than 10%, 10 points on a premium. So from an innovation perspective, it doesn't matter how digital you are, you're still, most people are digitalizing like 9% of that stack. And a lot of these other costs are still work. Like when it comes to distribution costs, average agency companies like 17%, and like Lemonade or Hippo, it's much more. And then the third thing that was super fascinating, I don't know if you saw Hippo's latest results, but I think their home insurance MGA is now one third of their premium. I don't know. To me, that was super fascinating. I think like one third is like First Connect, and then the other third is I forgot what it was, but it was like I think the home MGA was one third, First Connect, and then the other business. What's the other business that Hippo has? I forgot. It's something like that, but the numbers were super fascinating. So it's also interesting to kind of see how people are changing it.
Well, and I think if you look at direct distribution, the most compelling example is car insurance, $220 billion statutory market. You go back 25 years, pre-Geico, Progressive, 30 years, it was 100% through the agent channel, right? 2/3 independent, 1/3 captive. Today, it's about a third, a third, a third. So 1/3 independent, 1/3 captive, and 1/3 direct. Now, $220 billion times 1/3, those are big numbers shifting. But we have this perspective that, for example, in the car insurance market, the industry has completely shifted to the direct-to-consumer model, and the data just doesn't support that. And I think that you can have two thoughts and belief statements that you think are contradicting but aren't actually, which is I have supreme confidence that direct distribution is going to grow. The internet is just an incredible distribution model for any sector in any industry. But that doesn't mean the death or the end of the broker or the agent channel. In fact, I think it's incredibly important. And I think in most segments, it will still reflect the majority of it. And so we're just seeing a really interesting transition. And, these companies that we talked about, I mean, we started distributing through agents at Root because we knew we needed to diversify our channels. I believe Hippo and Lemonade do the same thing as well. And so even though some of these companies spend an inordinate amount of time saying, we go direct to customer, a bunch of them sell through agents just like everybody else does as well, right? The best business is finding your customers wherever your customers are and not being religious about that.
Yeah, and sorry, Hippo, I checked. The other third is Spinnaker. So they also bought Spinnaker to fronting.
Yes.
So out of the few hundred million of premium, only 90 million is going for the MGA. And now 2/3 of the revenue is businesses that have nothing to do with the home MGA. And out of the home MGA distribution, I think like 1/3 was embedded, 1/3 was direct, and 1/3 was agency channel also.
That's right.
Which is fascinating. I think Lemonade also renters are not doing through agencies because there's no money to be made. But home insurance, they're definitely pushing for agencies. And I know, for example, we have an appointment with Lemonade, which is interesting.
Yeah, and look, the risk with these channels, right? We watched the movie real closely, Root Insurance, the changes in Apple's policies, because what Root was so exceptional at was mobile acquisition, and they really didn't have much competition there, and allowed them to grow tremendously. And when Apple made their changes a couple of years ago, that was really disruptive, right? And that's the risk with having a concentrated acquisition strategy. You can be beholden to whomever the gatekeepers are within that acquisition channel. And so my feeling for any business is always diversify your customer sources, because otherwise you have risk.
Yeah, no, it's definitely interesting. So that being said, I think it's a good segue to move to what are you excited about? I mean, beyond just the MGA space, even in the MGA space, if there's anything specific, because again, like I feel like a lot of people realize just coming up with a new auto insurance MGA is not enough. Like there needs to be some kind of a leverage. I think it's some kind of an innovation that is a little bit more major and a little bit more customer value than just have a digital product that could quote you faster in a sense.
Yeah.
So what are you excited about?
I penned a blog post maybe 5-6 years ago, and I poked Flo, Progressive's character, the Geico Gecko, a little bit, and said, "Hey, there's more to insurance than this." But that blog post and a lot of my thinking during that time period was really around the end customer and their experience, which doesn't mean it needs to be an MGA. It could be a lot of technology, but in a market where market share was really what was being fought for. And consumer expectations or customer expectations from what their carrier and their agent should deliver were driving forces. I had a lot of my investment lens hovered around that. I think that is absolutely turned upside down in the last 18 or 24 months, because the tightening of the insurance market, in my mind, is just something that has totally turned everything upside down. And so many end customers now cannot get the coverage that they want anymore, or the pricing on the coverage is so crazy that they actually just can't afford to get that coverage. And so what I'm really looking for are tools that allow carriers, brokers, agents to help with that. That is providing end customers with more coverage by better understanding what that risk is, or by making the process of, because if you think about it, customers on one end, carriers on the other, brokers in the middle, making that marketplace, so to say, more fluid so people have the ability to have more choice. For an agent, for example, underwriting a small policy is a really, really taxing task. And so if they could go to more carriers because it reduces the friction, they can deliver more choice to their end customers. And so I'm really thinking about everything within that angle. And I also think that if you're a carrier and your loss rates are exploding because of interest rates or inflation, you can't fix that immediately, right? You will over time fix your book, but there's still a lot of waste inside of carriers and other workflows. And can technology be enablers for them to find profitability in other segments of their business by being more efficient?
Yeah, and to be honest, we're seeing that very firsthand right now, like both in terms of carrier appointments. A lot of carriers are careful with especially lines like property insurance. I think that's probably the toughest one in the personal line space that people are trying to place. But also agencies have been surprised with some of them are some. I wouldn't say like that many, but some that are even looking at rate filings before they come out. So they kind of could expect that carrier X, the rate's going to go up and they need to start moving the clients to somewhere else because they're going to have a churn if there's a 10, 20% rate hike in a sense.
Yeah.
So no, it definitely is a very valid problem. And you feel like the right way to approach it is two things. One, new product lines for carriers, new profitability and kind of like better distribution in a sense from that angle. And then the other side is just more marketplace and better underwriting for the end customer so they could actually find a market for it, which makes sense.
Yeah, just better understanding the risk. I still think that there is a lot of opaqueness where entities that have risk and are trying to offload that um, don't fully know the risk that they have, and the entities on the other end don't know how to fully assess that. But there's so many little things that we all within the industry understand. For example, an environment where rates are often getting hiked 10, 15, 20% per year. Those renewal notices, they often go from the carrier through the agent to the end customer without that agent having, a lot of awareness of that change in price. And customers, because the changes are so big, are suddenly catching notice of that. And so then they call their agent. They're like, "What the heck is this?" The agent has to pull those documents apart. They then have to call the carrier. The carrier has to explain that, and you just look at that whole process and you think to yourself, now multiply that times 10, multiply that by 100, multiply that by 1,000. That's a lot of inefficiency that's placed on the agency. It's a lot of efficiency that's placed on the carrier, and it's all due to the systems that we have today, and then not being designed for the modern economy.
Yeah, that makes a ton of sense. What else? Any other specific areas of insurtech that you feel like you're seeing a lot of exciting startups in, or maybe like I don't know, like you spoke a little bit about the product opportunities for new lines for profitability. So the question is maybe new product lines or new categories of risk that you feel like are exciting.
Yeah, and I may have overstated that a little bit. I think that there's always opportunity. I mean, over the last few years, cyber risk and pet insurance have been the two favorites at every conference as the high growth areas. To date, we haven't chosen to play in those areas. We do look at them, but I think that carriers are obviously looking for profitability, and so if you can find interesting places to allow them to go or allow people to take that, I think that's interesting. Though I think that in an environment where interest rates are rising and people are struggling to, like, I always have this running joke, which is like, if my house is burning, right? I'm not busy thinking about building a pool house. I think it's very hard to be truly innovative when, for a lot of carriers right now, their businesses are pretty challenged. And so I think they're going to be very cautious about the new areas and the new investments that they make. And they're going to really be making sure that their core products are really working well. I think cyber insurance is obviously something that everybody should pay attention to. We need to pay attention to. And so I do dig through that.
So here's a controversial topic for you. Do you feel like there's more startups and work in cyber insurance than the market has capacity for, or no? You feel like you're still very undertapped? Because there's like there's so many companies right now in cyber, and a lot of insurance companies are moving to cyber. How much more opportunity do you think there is for new entries?
I think the problem with cyber is we we don't know what it is yet, and we don't know what the loss rate is. And we have all these endless debates about, if somebody hacks into the sprinkler system, turns the sprinklers on, and it floods a floor. Does that get underwritten by the cyber policy, or does that get underwritten by the property insurance policy? Where does that fall? Who likes that risk? And then, within, for example, the online sphere, right? Are you covering if Amazon, if I get hacked, are you covering for that? And my customer loss rates getting lost? Or if Amazon goes down and I don't sell, are you covering for that? And so there's probably a whole evolution in understanding what the risk is of all of these different things that we're underwriting, simultaneously understanding that in the context of the other policies that we're already underwriting, and then going through what is maybe the most difficult part, which is educating end customers around that, which is, I think everybody increasingly understands how real cyber threats are. And we obviously want to sleep better at night. That is, we want to remove that risk off of our balance sheet. But when you look at the way to purchase those products today, it's pretty messy. And maybe my controversial perspective is a whole lot of cyber policies are being written, or a lot of like the excitement in venture around cyber policies is being written by relatively new MGA type, entities that are taking on a whole lot of risks that I at a distance look at and say, does anybody actually understand that risk? And so I'm probably a little bit more bullish about the old school carriers, the incumbents coming into these markets with their incredibly strong balance sheets and saying, we're going to take on a little bit of that risk in order to better understand it and explore it. But we're not getting in the deep end yet.
Yeah, no, I especially feel like with everything that happened with a bank like SVB, people are realizing balance sheets matter, especially for a risk like cyber that we don't know how catastrophic the losses are going to be. And they're not going to be backed by FDIC type entities. I mean, there might be reinsurers, but they usually have like a maximum capped amount that they're going to insure.
Yeah.
And that's why I think I'm a little bit worried about placing cyber with companies that are not backed by A-place balance sheets with unlimited, like reinsurance exposure. I just don't feel like the Congress is going to do it. So, yeah,
Yeah, I mean, what happens when AWS goes down for a day or three or a week, right? We all thought that SVB would never go down, that would be impossible, and it completely crippled the tech ecosystem. And I imagine that the best security experts in the world are working on Amazon, but I also imagine the best hackers in the world are also working on Amazon. And so much of our modern technology infrastructure is sitting on the back of that. And so when that goes down, all of the business continuity risk, right? Who pays for that?
yeah. So now let's move 10 years in the future and let's just start imagining what insurance or risk management would look like in the future. What do you see? What do you feel like the dynamics are going to be 10 years from now? The role of the agent, the broker, the reinsurer, who are the entities, who are the stakeholders, who are the products?
I mean, really selfishly, 10 years from now, I hope I'm on the board of a couple public insurance companies. That's mostly what I think about. That's what keeps me up at night, is how do I make that happen? But I think that you asked I asked I answered, what do I see? The question is, how do we get there?
This board that you're on, is it a virtual board because you're on your yacht and you're just dialing in with your Zoom, or?
Well, in between my margaritas, yeah. I'm sure you guys have all watched Silicon Valley, and
And you have a VR headset, and
yes.
you're sipping a margarita, and you're like Portofino on your yacht. No.
Yes. Tomorrow will be, in the last 60 days, my first non-red-eye flight. That's how sexy the life is of a venture capitalist, as you do non-Bay Area investments and you suddenly discover yourself taking, 4-hour red eyes to Toronto and not sleeping and turning around so you can actually see your kids. No yachts there, no margaritas, just, the same as the entrepreneur, selling and grinding away. But I think that I outlined some of that, which is, I do think that I'm super, super bullish about the continued sophistication of the agency and the broker. I do think that we're obviously seeing continued consolidation there, and I'm still trying to build perspective around what that means. But I think that the role of the broker and the advisor needs to continue to evolve away from purely the person that knows where to get your insurance, because I think that's going to commoditize a little bit more, to the person that enables you to get the right products and provides you consultative services and products. And so anything in that kind of area, I get very, very excited about. And then I think on the carrier side, the carriers have, to complement them, they invested in technology early in the 80s and 90s, and they have very antiquated systems, and it's limiting the pace at which they can move and innovate. To a varying degree, the regulated industries that should limit the speed. They're not the Facebooks. They don't move fast and break things. Nobody wants their life insurance or home insurance policy accidentally broken. But I think we brought up Guidewire here, right? Like I think Guidewire is an incredible company. It's an exciting product. It's not the most modern product out there, right? That was an on-premise software company that got moved into the cloud. It's 20-year-old software. And you go talk to most carriers, that's what they're really excited about. I think there's a whole nother evolution after that. And so, I'm looking at that. A market that I think is particularly due for an innovative drive is small business insurance. Having managed small business purchasing for small few businesses and also seen on the carrier side, these policies, these premiums are often, they're smaller than I can go online and buy my car and my home insurance in a matter of a few clicks and get a lot of comparison, a lot of information. I was doing some work for a small business a year ago, and it took me a week and a half to get quotes. And by quotes, I mean I got 2 quotes from my broker, and the size of the policy was a few $1,000s.
Was it one of the digital brokers and startups, or no? Was it not? Was it a traditional broker?
We were working with a traditional broker. I have the pleasant job of being the treasurer for my son's preschool, and so, this is an incredibly tiny business with, sub $100,000, not sub $500,000 in annual revenues, 4 employees, and a business that's never had an insurance claim in their life, and it took a week and a half to get quotes.
Alex, I work with a digital broker that is sold. It's one of the biggest acquisitions, and I'm not going to mention the name. It took me 2 weeks to get a quote. It takes me like once a week to respond to my emails, like the service support. And I'm like, you're a startup. Like, what is this? Like, this is bad. This is really bad.
It's really bad. And you sit there and you get 2 quotes at the end, and you think there must be more than 2 carriers that want to take on this risk, right? And then I do a little bit of work in this industry, and it takes like a PhD to pull apart the quote and understand what it actually is. Right. And I imagine somebody less sophisticated, right? Or, for example, my spouse, she runs an interior design firm. She does not move walls or anything like that, but she has a degree in interior architecture. And as part of the underwriting process, somebody looked at her LinkedIn profile and they quoted her as an architect in her business liability risk, right? And I look at what she does, right, which is hospitality design. She never, ever, ever would work on a hotel project without a structural engineer and an architect, because she doesn't want to take on that liability. But the insurance company decided that they needed to insure her for her presuming that liability risk, and it made her insurance incredibly expensive. And so and again, she's got 3 employees. These are small businesses, and the process is broken, in my mind. So
I'm going to give you 3 core theses that I have, and obviously it applies to COVID as well. And I would love for you to kind of tear it apart. Tell me I'm wrong, in a sense. Like I want, a different opinion, in a sense. Number 1, I feel like one of the biggest opportunities in insurance, not the biggest, potentially the biggest, is to own customer relationship and trust at scale. Because I feel like that's the key to the kingdom. Because, because we're building a platform, right? But the platform is only as successful as how many people you have on a platform that listen to you, right? And customers. Because once you have that, you could go to any insurance company and ask for, like, hey, I have all these customers. Do you want access to it? I also have all their data. Do you want access to it? Do you want all that? Do you think that makes sense? Or do you feel like, no, the other way of, because you kind of mentioned as well, because of the tight market, potentially the better analytics for the carriers could be potentially a bigger opportunity?
Yeah, I think, look, I always like the answer D, all the above. I think the challenge with owning the customers is you also have the burden of owning the customers. And owning customers is a pain. They're demanding. They want answers. If we go back to, for example, if they're small customers, right? No small customer runs their business and says, I'm a small business, so I should get small amounts of attention. The CEO of a Fortune 500 company thinks about their business with the same pride that a business owner of a 5-person company does. And so the challenge with the approach, which is also the opportunity that you're presenting, is if you own those customer relationships, you have to figure out a way to do it in a scalable and in a repeatable way. And you have to use technology to do that, because if you don't use technology, then you're not distinct from everything else out there in the world. But what is that technology, right? And I think that begins interesting conversations around chatbots, generative AI, online forums.
So the opportunity, I think what you're saying potentially a question mark around is the scalability and the unit economics of it.
That's right.
Yeah. The idea of, but if that was solved for, owning customers could be the biggest opportunity to reimagine insurance or disrupt insurance in a sense.
That's right. And so I see a lot of, tech-enabled brokerages. They go after interesting segments and they say, hey, and I find most of those businesses to be a bit marginal, which is all right. So, you've gone after a segment that is clearly lucrative. You can most definitively build a business of scale here because I look at the traditional agencies and you hired a couple software engineers. But I also find that the innovation in that model is exactly that. It's marginal. It's a couple extra engineers. And I worry that the scalability problems are going to be the exact same. You just have a little bit more software.
Got it. Okay. The second thesis is I feel that if we were to truly reimagine insurance, we would focus on risk management as opposed to selling insurance to people. The idea is we'll want to understand and communicate your holistic risk, not because I feel like the way that insurance is built today is that you have a car, therefore you have auto risk. Here's protection for your auto. Instead of understanding my risk holistically and managing it for me, in essence. Do you feel like that has any merit to it?
Just so I understand the question, because I think what you're saying is instead of selling somebody cybersecurity insurance, what we should do is analyze their cybersecurity, and if it's not up to snuff, not underwrite the customer, but enable them to have better cybersecurity.
I'm taking it a step further. I'm taking it because I feel like cyber is also a little bit vague. There are things that are a spread between digital risk and physical risk. That's why I would much rather know my risk, period, and then understand the causes of those risks and then find protection for those risks. But when I say protection, it shouldn't just stop at insurance. I feel like mitigation is a risk, kind of like there's an approach of actually, mitigating the risk with cybersecurity, for example, in your example. Or when it comes to insuring it, I could self-insure. I could use, insurance. I may just risk pool. There's like all these other models of financing that may be used in the future. Like for example, like if it's like health risk, we may want to do crowdfunding. Like in China, they had like crowdfunding models for risk. It's kind of like an insurance,
Yep.
or it's government backed.
Yep.
It's all types of insurance. But I just feel like we need to think beyond what it is today if we're thinking like 10 years from now, in a sense. And
Yeah.
I feel
Yeah.
like
Sometimes when I go to like, and I'm not a libertarian, but I know like Alex's libertarian place and view of the world, right? Which is like, I like that place. That's a cute place to hang out. I think to myself, what we really should do is arm people with an understanding of what their risk is, and enable them to make the right decisions, and really, almost a paternalistic way encourage those things. Right? There's a lot of mispricing in the industry today. And then I'm reminded all the time that people are really bad at assessing risk and really irrational. And so maybe to give a couple of consumer examples that I think, like it is fascinating to me how many millionaires and billionaires still buy home insurance, right? Not the liability, but the like my home floods, right? And you're like, you should self-insure that, right? At a certain point of wealth, you should actually be self-insuring a whole lot of things. And then on the flip side, you see these kind of transactional businesses like, let me insure my concert tickets in case it rains, where like those are terrible insurance products. By the way, you look at those businesses, the loss rates are fantastic, right? And the person who's purchasing that product, they're not looking to mitigate real substantial losses, the original intent of insurance. What they're trying to do is they're trying to comfort their own insecurities, and they're using insurance in order to do that. And so I think the problem when you start going too far down those paths is that the end customer may have a very different relationship to risk than you do, and maybe solving something very different than what you suspect it to be, right? Or like the incredibly low attach rates of earthquake insurance in California, like in the Bay Area, relative to other home insurance products. When you think about like a catastrophic event for most people, I understand it's expensive, but like earthquakes are that a catastrophic event, right? And yet people have an aversion to that. But I also think carriers could do a lot more. Like there's a lot of really cool things that carriers could do to mitigate loss, and they don't. And I bet they'd be profitable.
so with Vero, which was the other company I had, that's actually where we spent a lot of time understanding how people perceive risk. And you're absolutely right that people mainly understand the high frequency, low severity items, which is it's not logical. Nothing about it is logical. Like I think people are wired to buy life insurance, home insurance, and auto insurance, and they must have it because they were told that they should have it. And then they don't have like disability insurance, which for me is one of the most interesting examples because the severity is high, the frequency is actually very high, but then the problem is the price is high. So that's why they avoid it. So I remember I asked my friend, hey, why don't you have it? He said, hey, what's the likelihood of me getting it? I'm like 25% in your life. He's like, oh, so there's 75% it doesn't happen. I'm like, yeah, but if you think about it that way, you shouldn't have auto insurance You shouldn't have home insurance. You shouldn't have any insurance because these are all much lower frequencies. But at the same time, I realized it still gives us, like, once I started saying that, look, the AI has given you these recommendations, and then a human was handholding them to help comprehend it and all that, it did allow us to kind of cross-sell customers very well. And we had to piggyback off of an existing relationship. So we shouldn't start with a new relationship. That's where the role of the advisor or the agent was important, because they trusted them, as opposed to insurance company. And the combination of the technology plus the agent was much more powerful, because then it's like 2 or 3 different sources telling them the same thing versus just one source. That's where I was like, hey, I'm still excited, but I think it does take a lot of time to kind of educate people and get them there. But I feel like that's the holy grail of the future is
You just made me think of something that I always think is super wild, which is like much of the insurance industry, people use the phrase, oh, insurance is sold, it's not bought, right? And the areas where insurance is bought is most frequently the areas where it's statutory, like the person has to buy it.
Yeah.
And I think that people gloss over that, but find me other industries that I don't want to say take pride, but just gloss over the fact that their product has to be sold, it isn't bought, right? In almost all other industries, you try to create inbound marketing, demand gen, you try to create phenomena, education that enables people on the other end to wake up one day and say, that is a product that I would like to own. And we haven't figured out how to cross that chasm within insurance, and maybe within that there's tremendous entrepreneurial opportunity.
I feel like the knowledge hasn't been properly transferred because, for example, I've seen State Farm agents, because State Farm has the highest cross-sell ratio in the industry. They have 25% cross-sell ratio, which is tremendous. And a very good State Farm agent has as much as 50% cross-sell of life. An average State Farm agent has 15%, 1.5. An average independent PNC has less than 5% of cross-sell.
Right.
So it kind of, to me, it also is like a lot of lack of optimization, because there wasn't enough like people spending time on it in a scalable manner. That's why I was super excited about basically co-managing the customers of agencies, because that will allow you to kind of implement things directly, as opposed to just relying on training someone else that is, like an auto insurance agent is used to like people who want to buy auto versus having to sell them auto. But a life agent is completely opposite. And then sharing that knowledge, I think, is going to be key.
Yeah. Yeah, I mean, I think if I was a life insurance agent, I know all the money comes from the high end, complex,
Whole
policies.
life agencies,
But
yeah.
I think I would just sponsor like mommy and me classes, right? And sell like $200,000 term, 20-year term policies all day long, and super high volume and frequency, because there are these very specific events that we haven't figured out how to embed distribution in yet, or education, where like if you did it the right way, the stuff would fly off the shelves.
Makes a lot of sense. Um, so Alex, one last thing is, what do you feel like some of the trends that is going to impact insurance in the future, like things that are not insurancy, but it's going to impact risk or just the insurance industry, just from the other industries that you're, monitoring or looking at?
Can my top three be interest rate, and interest rates? I look. I think that I know there is a lot of hype around it. AI, and then subsequently generative AI. But insurance companies, by nature, live in a world of data. That is what they specialize in. And you can go survey 10, 100, 1,000 machine learning engineers, and they would all broadly agree that a lot of the things on the machine learning side are commoditizing, and the real skill set is in accessing and having the data, and then cleaning up that data. Because the other end of that equation, we're going to have enough engineers that are going to know how to do that. So I think that insurance has a huge, huge opportunity, given the relationship, the length of relationship, the volume of data that they have sitting inside of their organizations. This is as much an industry that is prided in the age of, I mean, find me another industry, maybe banking, where institutions consistently tell you how long they have been in business, right? That's like one of their core mottos. And so I look at that and I think to myself, absolutely. And then with some of the things that we talked about, the challenges of these low price points and removing the cost out of that. Again, you think about generative AI and what it can potentially do. My wife is in the market for an insurance product. She goes to ChatGPT now because the answers on Google are really confusing to her. And when she goes to chat, she asks the questions and it makes a ton of sense to her, right? And you look at that and you think to yourself, there is really something there. And I think that all the agents and brokers are going to incorporate some of these technologies to streamline their workflow. And I think the carriers are going to do the exact same thing. And so that has me pretty darn excited for insurance as a category that, can leverage that.
And what do you think is going to happen this year? We're going to see a lot of, like, for the remaining of the year, public market is closed. InsurTech, it's going to be all about Series A or.
Well, I don't know. I spoke to the folks that run the InsurTech Connect conference, and they started telling me that they were going to move it more towards fintech to broaden it. And I thought that was interesting, like trend of the times, right? Like, insurance isn't sexy enough. That's not successful enough. We need to somehow bring in payments. But I think, what do I think? I don't think we're going to see much on the venture side from a financing perspective, nor from a IPO perspective, right? I think that this is the incredibly painful period where people try to build good businesses. I suspect that not so much on the public side, but on the private side, we'll probably see over the next 18 months some flameouts. So you're already seeing that on the prop tech side. And I think that on the insurtech side as well, there were some businesses that were funded where you're just like, was there ever really a business there? And, that's going to be going a little bit quieter because nobody ever likes to publicize those things. And then I also think that some people have been making those really, really tough decisions over the last 18 months, 12 or 24 months. They were ahead of it. And I think they're going to start looking to be in growth mode. The most exciting thing in this market is that the biggest challenge within venture-backed companies was competition and access to labor markets. And the decreased funding right now has, decreased the amount of competition. And the labor markets are starting to look really, really compelling. And so if you're an entrepreneur that's been running your business in a fiscally responsible way, there is going to be some tremendous opportunities here in the next 12 to 18 months to build based on what we're seeing.
Perfect. I think I really enjoyed the conversation, learned a lot. Thank you so much for making the time.
Absolutely.
I don't know if you have any last words.
No, I'm just super excited to be chatting with you doing this. And, folks can reach me, Alex at Scale VP. I also have a pretty grumpy and cynical Twitter account, first initial, last name, A. Niehenke, that you're welcome to follow. And if you think that the picture looks funny, yes, that's me at 18 years old. And I'm probably on like Face, Snap, and other places, LinkedIn and such as well. I'm pretty darn responsive. So welcome anybody to reach out if you want to, chat a little bit more insurance with me.
Love it. Alex, thank you so much for making the time.
Absolutely.
Take care. All right.